Can you touch on the retail bullion phenomenon that you're seeing both in terms of demand, supply, physical availability, and premiums?
Yeah, demand is really strong right now. Supply, which has been really good for a while, is getting very tough. And why is that? It's because supply was so good that the dealers didn't re-up. And with the rising prices, the cost of carrying this stuff is very expensive. The cost of shipping it has become very expensive. The cost of insurance to ship it has become very expensive. Just the cost of holding a large inventory has become very expensive. You better have millions and millions and millions of dollars in order to run an inventory, or you have nothing. And so, I look at our inventory, which is, I'm not happy with it right now. It's gotten so low so fast. And this is one of the things I was concerned about. And I say this on your show all the time. Just like that, it changes. And the market does change. And it wasn't just the companies like ours that feel this. It goes all the way up to the primary distributors who, again, they were choking on product too for a while. Like you said, that was slow at the beginning of the year. And just like that, it's not. And there's lag time between getting new product in from around the globe. The U.S. Mint, who really is the model of inefficiency, can never keep up adequately. And this is with now just a glimmer of new demand, and maybe it's coming from higher levels because you're getting this advice coming from Morgan Stanley and Jefferies and Bank of America. These people are talking, the CIOs or Michael Hartnett's of the world aren't talking to Jane and Joe Sixpack. They're talking to their institutional clients, their big money clients who are paying huge money for Michael Hartnett's writings. And same thing with the chief investment officer of Morgan Stanley. That's not stuff for the public. You pay for that stuff. This is the stuff that's given to their big clients. These are the people who are making moves before the public. The little man is still sitting in the Mag 7. The little man is still sitting in traditional assets, really doing or set up to do as well if things continue as the insiders are selling and the public is all in. It's something that concerns me, honestly. And you've had me on your show here now talking about this really since 2024, where it's been slower than we would expect in an environment that shouldn't really, if you look at the facts, it shouldn't have been slow. But now people are waking up, not just the diehards that you and I have spoken to forever, the mainstream, just a little sliver of it, and probably the sophisticated side, the well-informed side, more so than the masses. But when you get, Dunlock and Bank of America and Morgan Stanley and Jefferies all saying the same thing, that's going to change. And now all of a sudden supply is becoming tougher to come by. Premiums are rising, and it doesn't take a whole lot of demand to wipe out inventories that have not really been aggressively added to. So we are in the process of doing that right now, but there is a lag time. And I would say to you, you haven't seen anything yet in terms of demand. If these guys are right and they're telling, putting the seed out there that, hey, this is about to explode, just a small uptick from the public will decimate availability in this industry overnight. And I don't say that lightly, I mean it sincerely. There's so much money out there, not to mention M2 spiking right now, money creation and just money in circulation that's been sitting on the sidelines in places like money markets and in treasuries, which are now being, maybe you shouldn't own so many, reevaluated by the people who sell them. I think that ultimately, I've said it before, I'll say it again, I'm not talking my book. I'm not trying to get you to run to the phone and make a phone call, but I'm dead serious. I really do believe that this market, before it's all said and done, will be looked at two ways by the people from the outside. Geez, prices got so high, I'm out. And the people on the inside, I want more, but it's so hard to get it. And the prices, the premiums are high and the delays are high, and used to be so easy to get it. I took that for granted, and now it's next to impossible. I believe that'll happen. I do. Because on our interview with Rick again this morning, he talked about the 0.5% allocation. What if it's 5%? Well, these guys are saying 20 and 25%. If it went to 25% or even 20%, Well, that's a 40-fold increase, just like that. Do you think that this industry can survive a 40-fold increase? Not a chance in Hades. And it would be lucky to survive 24 hours with a shift to that magnitude. And if they're saying 20 or 25, what do they really mean?
You know, I was looking at my phone earlier today, checking the futures markets, and I had one of those moments where I just shook my head in disbelief. Silver futures sitting at $47.30. Gold futures tacking on $50, trading up near $3,858. These aren't just numbers. These are statements. The kind of moves that tell you the ground is shifting beneath us. Now let me be clear. I don't expect gold and silver to move up like rockets every single day. There will be sharp pullbacks. There will be scary days that shake people out. That's the way bull markets work. They want to test your conviction. But the strength I'm seeing right now is not normal. It's not what we've been conditioned to expect after years and years of price suppression, of capped rallies, of endless paper contracts being thrown at the market. This is different. And the reason it's different is because the big money is finally moving. I don't mean the stackers like you and me. I'm talking about the pension funds, the sovereign wealth funds, the university endowments, the insurance giants. I'm talking about the guys who move billions with a few clicks. These people are reallocating, and you can see it in the ETF flows. Volumes are surging. Demand is off the charts. This isn't retail money. This is institutional. And let's not forget how we got here. For decades, Wall Street told you the holy grail of investing was the 60-40 model, 60% equities, 40% bonds. It was treated like gospel. But that was built for a world where interest rates were 6% or 7%, where bonds gave you safety and income, where stocks were driven by real growth rather than constant monetary stimulus. That world is gone. Bonds are now guaranteed losers. Stocks are overvalued casino chips, and the so-called safe haven of treasuries is losing its shine fast. That's why you're seeing Wall Street finally break the taboo. Morgan Stanley's chief investment officer came out and floated a new model: 60% stocks, 20% bonds, and 20% gold. Do you understand how massive that is? If even a fraction of the trillions managed by firms like Morgan Stanley are shifted into gold, the market is going to explode higher. And remember, that kind of guidance isn't meant for the public. That's not advice for Jane and Joe Sixpack. That's research for their biggest clients, the institutions, the sovereigns, the billionaires. They're the ones making moves before you ever hear about it on CNBC. And it's not just Morgan Stanley. Bank of America's Michael Hartnett is talking about a 25, 25, 25, 25 portfolio. Stocks, bonds, T-bills, and gold. He even showed the math. His model is up 16% this year versus 10% for the old 60-40. Why? Because gold's up nearly 50%. The metal carried the portfolio. That kind of performance gets noticed. Chris Wood, the global head of equity strategy at Jefferies, came out and said gold could run to $6,600 in the near term. Think about that. A Wall Street strategist publishing a price target that sounds like it came straight out of the gold bug fantasy playbook. And Jeffrey Gundlach, the bond king himself, has said gold is going to $4,000 by year end. When the casino owners start betting against their own game, you'd better pay attention. And then there's China. You want to understand where this is headed? Look at what Beijing is doing. They're not just buying gold hand over fist. They're building vaults all across the global south. Hong Kong, Shanghai, Singapore, Dubai, Riyadh, St. Petersburg. They're creating a parallel vaulting system to New York and London. Why? Because trust is dead. No one trusts the West's paper promises anymore. Countries want their gold in their own vaults, under their own flags, in their own jurisdictions. That is a tectonic shift. And it's happening in plain sight. Now, I've always respected Michael Oliver's work, and when he says the lid is coming off, I listen. His momentum indicators are showing silver between $100 and $200 over the next year. He's telling people, don't be fooled by the corrective jolts. They're part of the move. And he's right. Every great bull market in metals has violent shakeouts. If you get scared and sell, you miss the run. And it's not just silver. Gold has broken out of a 12-year channel. We are poised, according to Oliver, to see a new all-time monthly close. That's huge. And what's important is that gold isn't just rising against the dollar. It's rising against every G7 currency. The euro, the yen, the pound, they're all collapsing in purchasing power. Gold is revealing what fiat currencies really are, promises that can't be kept. Let's talk about Gundlach again, because he nailed something important. He said your savings account is bleeding 4% a year. In reality, it's worse. M2 money supply is growing at 7% to 10%. Real inflation, measured honestly, is double digits. Your $10,000 in the bank today is worth $8,900 after the debasement. If you buy a 10-year treasury at 4%, the IRS takes 25% of that interest, and you're still negative after inflation. Lending to the US government is now a guaranteed way to lose purchasing power. Meanwhile, gold's up 40% this year. Silver's up 50%. The miners are ripping. Who's the fool? The guy stacking metals or the guy buying treasuries? And here's the kicker. For decades, the banks trashed gold. They mocked anyone who talked about it. Now they're publishing research saying gold should be 20% of your portfolio. Bank of America is telling you gold is outperforming the old 60-40. Jeffries is saying $6,600. Gundlach says $4,000. The hypocrisy would be hilarious if it wasn't so infuriating. But that's how this game works. They trash it until they're in position. Then they change the narrative. And by the time the public wakes up, the price is multiples higher. I've said it before, and I'll say it again. When the dust settles, people are going to look back at this period in two ways. Some will say, prices got too high. I missed it. Others will say, I can't believe how hard it is to get physical metal now. Premiums are crazy. Supply is tight. I took it for granted when it was easy. And that's the group I want you to be in. The group that acted early. The group that held through the volatility. The group that saw through the noise. Because make no mistake, this is just the beginning.